we're going to take a detailed look into the financial statements and ratios of a listed company, and in this case we're going to look into Mr. Price. When we get together to do the webinar, we will have the opportunity to look into any listed company that you choose, and we will follow the same pattern of analysis that I'm going to do for you now. So included in this slide presentation is a screenshot of the ratios for Mr. Price. However, what I'm going to do is I'm going to bring in my spreadsheet that has all this data, and we're going to do a comprehensive analysis of Mr. Price. So I know as you look at that for the first time, it perhaps feels quite overwhelming. So let's step through it and see what's here. Let's start up here in the top left hand corner where we have the 3-letter ticker code MRP that describes Mr. Price on the JSE, and of course there its full name is. I have another code here for a database that collects data for me, so that's a repeat of the Mr. Price code, and I have several codes down the left hand side here that are also references to a database. These won't be relevant to our analysis. Let's jump in here with a year-end share price. So we've got some data here that goes back to March 2013 and includes the March 2017 annual financial results for Mr. Price. And at the year end in March 2013, Mr. Price had a share price of 116 Rand and 99 cents. You can see this went up to 157, up to 260, and then over the subsequent 2 years declined back down to 159 Rand and 90 cents. And as of yesterday, the 23rd of July 2018, the share price there is 224 Rand and 40 cents and appears to be moving upwards. Our next line here is EVA, which refers to economic value add. We haven't covered that so far in our modules, but we'll get to that in a subsequent module. The next ratio here is the return on invested capital, which was the analysis, the advanced performance analysis that I did in the last module. Here's the return on equity, and here's our cost of capital. If we look at the return on invested capital for Mr. Price, we'll see that in 2013 this was 39.5%, and if you recall, we said we wanted this to be greater than the cost of capital, which was 18%. So that was certainly the case in 2013, which implies that Mr. Price is creating value and providing returns to its investors and capital providers that are higher than the cost. And we see that this ratio is trending upwards, certainly to there. It appears in 2016 to come down a fraction, and then in 2017 there's a substantial decline in the return on invested capital by approximately 10%. It turns out that the return on equity and the return on invested capital are almost identical, and we'll have to explore why that is the case. We'll come to that a little bit later. I've got a price to earnings ratio. Price is the share price and the earnings is the earnings per share, and here we have this ratio at 17.7 in 2013. It goes up to 27.4 in 2015. This might imply that the share price is getting expensive, if you want, and you'll see it correlates to the share price going up. So that means the price is increasing faster than the earnings per share, and here it's declining as the share price declines. Let's dive into the income statement, and then we'll come back to the ratios and explore them in more detail. So you'll recognize here that the income statement is almost identical to the discussions that we've had so far. There might be one exception, in that you will see there's an item here called the total interest received. Sorry, let me highlight the right item, is that item. And in our discussions up until now, we've just had an interest paid component there. But of course, companies have loans to other businesses. They have cash invested in money market accounts, or simply in their own bank accounts for the business, and these earn interest, and that's often a source of income for the business. We don't include it in the sales, it's itemized separately. Let's go back up to the top here. The turnover, this number in 2013 is 13.2 billion, give or take a rounding error, and we see this increasing to 15.8 billion in 2014, and this represents a 19.3% increase from one year to the next. This goes up by 13.8% in 2015, goes up even further in 2016 by 10.3%, and then it appears that in 2017 the sales, or the turnover, is effectively stagnant. Perhaps it's important to notice here that, or to know that this includes the Christmas period for 2016, and that turned out to be a poor sales period, poor season for Mr. Price, and was mostly the reason for their sales not increasing as they had in previous years. We see here there's a record of double-digit sales growth, certainly in the early and some cases late teens. So 2017 was clearly quite a different outcome compared to history. Well, we subtract the cost of sales and we're left with a gross profit. This is all the work that we've covered up until now. And here I've measured a gross profit percentage. So we're simply taking the 5.6 billion, dividing it by the 13.2 billion, and that gets us 42.2%. And if we do this year on year, we can do some horizontal analysis, and we can see that this is fairly consistent from one year to the next. A slight decline in 2017, but pretty consistent. Paying some expenses. So we can see here that in 2013, Mr. Price was paying 3.3 billion in expenses, and here we're talking mostly salary and rental expenses would be the two highest components there. This is going up to 4.9 billion in 2017. There's some depreciation expenses here. Obviously, Mr. Price has some depreciating assets on their balance sheet. And then we're left with operating profit. And you can see 2 billion becomes 2.5 billion, becomes 3 billion, becomes 3.6 billion, and then there's a decline. It goes down to just over 3 billion. And we can see this decline in their operating profit percentage. It's growing nicely up until 2016, and it goes down to 15.5% in 2017. And obviously what happened is they had some increased expenses coming into the system, and these were not matched by probably expected increase in sales. So that's resulted in that decline in profitability. Generally, from an interest paid perspective, Mr. Price doesn't pay much interest at all, which implies that they have no debt. And that's been a trend for Mr. Price historically, and typical of the retail sector being mostly a low margin sector, and not being a sector that embraces substantial use of debt. There's some interest received, and that then leaves us with a profit before tax. We then pay some taxes, we're left with a profit after tax, and again here we can measure the profitability, and we can see how this has increased from 11.6 up to 13.3%, and there in 2017 is a decline. Mr. Price is a good dividend payer, paying out approximately half of its profits in dividends, and there are the retained earnings that flow through into the balance sheet. So if I look back up to the return on invested capital, I want to answer the question as to why has that declined so significantly in 2017. And if you recall, our dashboard for return on invested capital is profitability times activity, and profitability is a function of the operating profit. And if we have a decline in the operating profit, that is going to be the major driver of this decline in the return on invested capital. At this stage, I don't even have to look at the activity. I'm pretty sure that that probably went down as well, but the main driver of these decline in returns will be the decline in this profitability. We can say the same for the return on equity, where this number has declined there by approximately 9% over those 2 years, and that will be driven by this decline in the profit after tax percentage. So if you recall, the return on equity was a measure of profitability times activity times leverage. And it turns out that if the leverage for the business is 1, in other words, there's no debt in the business, well, the return on invested capital and the return on equity will be equal to each other. And that is what the case is here for Mr. Price. For most of the years, pretty much equal to each other. Perhaps a small rounding error difference here. And that is a reason, or the reason for that is the fact that Mr. Price doesn't use debt in their business. I'm going to scroll down, and you'll see underneath the income statement there is the balance sheet, and here in the first half of the balance sheet we have what we called up until now our equity plus our debt components. And even though I'm going to jump straight here to the interest-bearing debt, I want to have a look at that in a bit more detail. You'll see that there is some debt here. That number is 51 million. But in the context of a 7 billion rand balance sheet, you might say that's a rounding error. And hence, when we measure the leverage or the debt to equity ratio, that is rather insignificant. The bottom half of the balance sheet, you will find the components that we've looked at in a lot of detail in the work that we've done so far. The fixed assets, and here we find the working capital components. I'm not going to go into any detail here in the balance sheet for now. We perhaps could have some more detailed conversations in our webinars together. I want to move on down here to this ratio analysis. So in this ratio analysis, we have a number of different ratios that we're measuring here. The ones that I've highlighted are the profit after tax, the net asset turnover rate, which we refer to as our activity ratio, and here is the leverage ratio. So I wanted to identify profitability, activity, and leverage. And if we multiply profitability, activity, and leverage, remember we end up with the return on equity result. And if we come along here to the difference between 2016 and 2017, there we see that significant decline of, in this case, nearly 10% decline. And we wanted to find out the reason for that. Well, we would come up here and we would see there's the profitability declining, and there is the activity declining. And that decline in activity is mostly because the sales went down, only marginally, but however they went down in proportion to the net assets. So therefore we had a decline in activity and no change in the leverage. That's effectively 1. In other words, Mr. Price has no debt. So that's the reason for the decline in performance in 2017 for Mr. Price. There's some other ratios that we can have a look at here, and specifically we might ask ourselves the stock on the shelves at Mr. Price. How long is it there for? So this might not be specifically on the shelf, but it's in the system at Mr. Price between warehouses and distribution centers and shelves, etc., in stores. And you will see that this number hovers round about the 60 days, sometimes stretching up a little bit. But we can say there's probably an average of stock on the shelves here for 2 months. How long do customers take to pay? Now we need to explore this number in a little bit more detail, because I would suggest that that number is misleading. So the ratio, the formula for calculating debtor days, is to take the debtors in the balance sheet. Let's go and find that number. Find the debtors in the balance sheet. There it is. The trade receivables is the new age accounting term. To take the trade receivables and divide that number by the credit sales. Credit sales. So we would come up here to the sales, and we need to ask ourselves how much of those sales are on credit. Now I don't know that number from the data that I've got here. I would have to go to the annual financial statements. I would have to look it up specifically. I'd have to make adjustments to this number to find out the proportion that are sold on credit in order for my formula to work correctly. Since I don't have that data in my spreadsheet, I simply take the debtor number and divide it by the total sales. That gives us a worst case scenario. So if we come down here and we look at the debtor days again, that would be a worst case scenario. And I would say that's quite high and probably not the case. I don't think the average customers at Mr. Price take 43 days. There's a large proportion of cash sales at Mr. Price that are paid immediately. So I'm not going to pay too much attention to that. What I am going to consider is how long Mr. Price takes to pay its suppliers. That's what the creditor days is. And you'll see here that it's 2 months. It pushes up here, becomes almost 3 months in 2014, but we see that declining back down, and now it's sitting at just less than 60 days. So that would be 2 months. And if we were to do the calculation for that, what we would do is we would come and find the trade payables number. There we go. Mr. Price owes its suppliers about 1.8 billion rand. It's interesting to see how that has declined from the 2016 year. But the calculation for creditor days would be the 1.8 billion, and we would divide that by the cost of sales, and I'm assuming that that cost of sales number is all on credit. In other words, everything they buy from their suppliers is on credit, and if we divide that creditors number by the cost of sales and multiply it by 365, we would end up back at our creditor days number, which is approximately 2 months. And it's interesting that the inventory days and the creditor days mostly match each other. So you might say that the stock on the shelf is sold just in time for Mr. Price to then pay its suppliers and have a net cash effect that balances each other out. Okay, so we're back up here at the top of the spreadsheet looking at the income statement for Mr. Price. And holistically, I would say that Mr. Price is a business that definitely creates value. In other words, it earns returns that are higher than its cost of capital. That's the first measure of value creation. However, the second measure of value creation is to meet shareholders' expectations. And we can see here that from 2013 to 2016, some expectations have been set that the returns on invested capital are close to 40%. So when these returns decline as substantially as they did in 2017, one might suggest that the expectations of the shareholders haven't been met based on this performance. And I would say that's the primary reason for this decline in share price. If we were looking to find a reason, if we possibly could, we would say it's mostly because of these declining returns of Mr. Price, because of this reducing operating profit, because of the fact that there was negative sales growth in 2017. So then we might ask, well, why is there a sudden increase in this share price from the end of 2017 to where we are now in 2018? And we could go and look at a share price chart here of Mr. Price and explore what's gone on. And we would start back here at 2005, and we would say, what if we invested R1 in Mr. Price? Then we would follow this red line, and we would find that this R1 by the end of 2014 probably become worth 23 Rand and 25 cents. Some really great performance. And then there's a decline here in the share price towards the end of 2015. In 2016 there's a spike up, and then this further decline back down to these lows at the end of 2016. And 2016 come 2017 here was that poor performing year for Mr. Price. It appears that the 2017 year produced substantial share price gains, got us back up here to just under 300 Rand share price, and here in early 2018 the share price has come down a bit. But what we could say is that R1 invested in Mr. Price in 2008 would have become nearly 20 Rand by 2000 and mid-2018. So we're reading that return off the left-hand axis here. And on the right-hand side, we've got the share price, the actual share price for Mr. Price. Now we would compare that to an investment made in the all-share index, where R1 invested in the all-share index in 2005, come 2018, early 2018, would be worth R4.33. This suggests to me that Mr. Price has outperformed the all-share index substantially, and would have proven to be a fantastic investment historically. But of course, history is history. If you weren't invested, you lost out. What we're interested in is what's likely to happen in the future. And the best we can do in predicting the future is to ask ourselves, well, what's happened in the past, and are we able to use that as some sort of trajectory into the future? I think if we look into the 2018 numbers, we will see a substantial improvement in performance for Mr. Price, and those numbers have been reported with interim results during the year, and that's driven up the share price performance of Mr. Price. But what we've done now is we've had quite a quick run through of the holistic performance of Mr. Price, and we will look at a few other businesses when we get together in the webinar. So that brings us to the end of our module on Mr. Price's ratio analysis. We'll see you in the next module.